The next policy we're going to consider is another one that you probably are very familiar with, taxes, right? So you've probably paid a fair amount of taxes in your life. Most commonly, you're probably familiar with your consumption tax, right? The sales tax, those kind of things. But you've probably also worked a job before, and maybe you've got some taxes on your income that you've earned. You've also, every time you bought a gallon of gas, you were paying some taxes on that, right? So there's taxes a lot of different ways. Some of them we see very directly as us on buyers, and other times we're paying the tax, but it's built into something on the seller side of the market. The seller is the one who's responsible for paying the tax, but it does influence us as buyers, but we don't directly see it advertised the way that we do sometimes, right? An important outcome or an important outcome of our models is that it doesn't matter in terms of whether a tax is placed directly on buyers where they can see it, or whether it's built into the price that sellers are offering to the buyers. It doesn't matter. Our basic model says it does not matter in terms of outcomes. As an interesting side note, there is a ton of empirical research to suggest, again, there's a difference between, in our models, what rationality looks like, and it sounds like rationality in our models. Everyone's a computer and does these calculations and is able to incorporate these prices. But when we actually look at some behavioral economics and we look at what some of the data suggests, if you advertise, if you put a sticker price on an item and it has the tax explicitly incorporated into that sticker price versus just having the sticker price and advertising what the sales tax is, there is very different reactions by consumers. Consumers do not rationally evaluate the impact of prices. We know that, but this is a good model as a starting point to understand how markets operate. And then we can think about how far away we are from this hypothetical uber rational model. In this hypothetical uber rational model, it absolutely doesn't matter in terms of outcomes whether the tax is placed on buyers or sellers. In the real world, it does. Here we go. Taxes. This is a main takeaway. What taxes fundamentally do is they drive a wedge between two different prices. When we think about buyers and we think about sellers and we think about them coming together, right? Prices are common between the two, but they play different roles. When buyers are thinking about buying a good, the price to them represents how much money they have to give up in exchange for getting a good. Whereas for a seller, a price represents how much they're going to collect in exchange for giving up something that they've acquired, either by producing it or some other way. Up to this point, we were assuming that buyers and sellers, when they were making their decision about buying and selling things, they were on the same page, so to speak, in terms of the prices that they were using in their respective decisions. Now, what taxes do is taxes drive a wedge between those two prices. And so we've got to differentiate between the price that buyers pay. When buyers go in and they make a purchasing decision, what is the price that they think about as they make their decision? And also, the price that sellers receive, meaning, at the end of the day, how much money is the seller going to hold on to that they can use to cover their costs of production? In the past, those were the same prices. Now, there's a wedge between those two prices. There's a difference between those two prices. So we can think about this with two little thought examples, right? So you go and you buy purchase a sweater, and there's a 5% sales tax. It's because mathematically that's an easy thing to do. In Michigan, it was always 4% when I was growing up, and that was really easy math to do, right? But now it's a little bit different values. The sweater sticker price, you walk into Meijer, Target, something like that, you see a sweater on the shelf, and the sticker price is $100, right? Rationally, what you should be doing is you should be thinking about, okay, yeah, I know that this is advertised at a price of $100, but if there's a 5% tax, I know that there's going to be an extra $5 that I'm going to fork over. So when I'm making my decision about that sweater, the relevant piece of information that buyers should be using rationally is the $105 they're going to have to give up, right? So when they're thinking about the benefits of that sweater and is it worth it, they're comparing those benefits against this price of what they have to give up of 105. Whereas this retailer, when they're thinking about stocking that sweater on a shelf, right, that has a cost associated with it. They got to get the merchandise, and there's also some shelf space. There's an opportunity cost. So when they think about is it worth it or not to have these sweaters on the shelves? They got to think about how much money are they going to be able to collect from that. Now, yeah, they're going to collect $105, but $5 of that they're going to have to set away in an account, and periodically they're going to have to send that money to the government. The true amount of money that they're going to be able to hold on to is $100. So when that retailer is thinking about whether or not that sweater on the shelf is worth it, they should be thinking about that price of $100 that they're going to be able to keep after they've paid their taxes. So again, this is what I was alluding to earlier. There's now a wedge. The two different sides of the market are making different decisions. They've always made different decisions, but when they're making their different decisions, they're now using a different set of prices in their decisions. Buyers are using a price of 105 and sellers are using a price of 100. That is going to lead to an inefficiency, as we'll see in a few minutes. That's the story about when we have the price like a sales tax, where the tax is placed on buyers. Buyers are directly assessed the tax at their time of purchase. There are also things like taxes on sellers. And again, the gas tax is a great example of this. I love these numbers. These are from a number of years ago to remind me, mostly for myself, about how expensive gas used to be and how gas isn't nearly as expensive as what it was in the past. At the time that I first came up with these numbers, the federal gas tax was 18 cents and the state of Ohio tax on gas was 28 cents. The gas sticker price was $3.78. That seems really expensive. And again, when you are a buyer at the time, you go in, you drive by a gas station, this is the price that they advertise. When you go in and you buy 1 gallon of gas, this is the price you pay. This is the amount of money that you fork over. However, in that price of $3.78, 46 cents of it was tax. So while the gas station had to collect $3.78, they had to take 46 cents and put it into a special account and periodically send those payments to the government, right? The taxes they collect, they had to send to the government. And so really, right, you as a buyer, when you're thinking about, is it worth it to buy a gallon of gas, the relevant price you're using is $3.78. But for the gas station, when they're thinking about their costs of operations and thinking about what it's going to take for them to be profitable, they may collect $3.78, but see if I could do this math real quickly. How much are they actually going to hold on to? And I'll scratch that out to make my math easier, right? $3.32. That's how much money they're thinking about to help cover their costs of production. That's the money that they get to hold on to for each gallon of gas that they sell. Again, here's the wedge. There's a wedge between the price buyers pay and the price sellers get to hold on to pay for their cost of production. Taxes drive a wedge between those prices. And also notice that what did taxes do to the price buyers pay? It meant that buyers are paying a higher price. An interesting thought experiment for you to do is think about, right? So if we went to current day gas prices. Okay, so I just pulled up some gas prices locally, and it looked like they're running about $2.30 right now. And so that's the price that me as a buyer, that I'm paying for a gallon of gas. The price that sellers receive, notice this notation I just introduced. PB for the price buyers pay, PS for the price sellers receive. Let's again assume that we've got a 46-cent tax, just to make my life a little bit easier for calculating. It's $1.84 if I did that math right. $1.84 plus 46 cents should get me to the $2.30. So right now, every gallon of gas that I buy, I fork over $2.30. Every gallon of gas that a gas station sells me, they get to keep $1.84. The 46 cents gets sent to the government, both state and federal, right? One of the interesting questions that we can ask to help think about this model is, what if the government eliminated all taxes? What if all gas taxes went away? What if they were zeroed out? What price would I start paying as a consumer? Do you think that I would pay a price closer to $2.30? Do you think I'd pay a price somewhere in between these two? Or do you think I'd pay a price all the way down at $1.84? What do you think I would end up paying as a consumer if we zeroed out the gas tax? We can think about this market for gas, and we can consider first a tax that's placed on sellers in the market. So again, make sure that you understand all the different pieces to this market, right? I've got, what does P represent? This is the price of gas. Q, this is the quantity of gas, either both quantity demanded by consumers or the quantity supplied by businesses. Demand, the demand for gas is a downward sloping line. Is it clear why demand for gas is a downward sloping line? Do you think it's a steep or a flat curve? How about the upward sloping supply of gas? Who does that represent? And is it obvious why the supply of gas is an upward sloping line? Right? All those things we've covered. And we assume that we're at market equilibrium. So this is the price of gas. We're again thinking about a market first with no taxes whatsoever, and then we're going to add taxes to the story. That's clearly not what we have, but think about what if we add that kind of market. This is the equilibrium price of gas. We're at that equilibrium price. The amount that consumers want to buy is equal to the amount that sellers want to sell. That's what our market equilibrium is. And again, we can think about in the upper right-hand corner, I don't want it to get too messy, but you can think about their consumer surplus and producer surplus. Now, let's assume that the government steps in and they decide to put a tax on sellers. Taxes, are taxes going to influence buyers in this case or sellers? If it's a tax and it's placed on sellers, that's going to make sellers' job more difficult. That's going to reduce effectively supply. So let's go ahead, and I've got this little tax right here. Let's assume that this is the size of the tax. If there's a tax placed on the market, what it's going to do is it's going to, nope, I don't have a line there, so I got to add a line I couldn't remember, right? If we've got this supply curve, let's go ahead and take that supply with tax and shift it up by an amount of the tax. This is the supply with tax. Originally, we had the supply without tax that was just a function of, right, that original supply curve is only about the cost of production. Now, the supply with tax, it shows the cost of production and the tax that these businesses have to pay, right? Step one, where is your market equilibrium, right? So market equilibrium is going to be where supply and demand intersect, but now we've got and that used to be Q star, but now our market equilibrium, where is quantity demanded equal to quantity supplied? Now with this higher cost of production and this shift in the supply curve, the new market equilibrium under taxation is going to be a lower. At this new market equilibrium of taxation, the amount of quantity demanded is going to be equal to the quantity supplied. It's a lower amount because of the additional impact of taxes on the supply curve. The supply curve is not just the cost of production, but now it also includes the taxation. When it shifts back, my equilibrium shifts back. The other thing we want to show is these two different prices, right? The price buyers pay and the price sellers receive. Once we know what the quantity is, then we can go back and identify the different prices. So if I take this quantity, this lower equilibrium quantity, the demand curve, I took this quantity all the way up to the original demand curve, and it is where we'd see the price buyers pay. And not surprisingly, what do taxes do? They discourage activity, right? When we put taxes on things, less of it happens because it's an additional cost. It also, for buyers, raises the price that buyers have to pay. One other piece to this, though. We know that buyers are going to end up paying a higher price, but do you think that sellers really want to push all of the additional tax onto their buyers? If sellers pushed all of their tax onto buyers in the form of higher prices, they're going to lose a maximum amount of buyers. Sellers are actually willing to take a little bit of the hit on their end. Sellers are willing to take a lower price. The way that I identify the price sellers receive is, again, at this equilibrium, if I take it up to the original supply curve, not the one with taxes, but the original supply curve, that original supply curve tells me the price sellers receive. When the government steps in and puts a tax on a market, it does two things. It, number one, is going to push the price higher for buyers, but sellers are also going to be willing to take some of the hit on their side so they don't quite lose so many buyers. But fundamentally, what we end up with is still the same wedge that we talked about earlier. This difference between the price buyers pay and the price sellers receive. This right here is all of the market equilibrium outcomes for taxes. We've got a lower quantity, we've got a higher price for buyers, we've got a lower price for sellers. What I want to do next is I want to talk about the welfare implications. Again, that consumer surplus for yourself. Can you remember where is consumer and producer surplus? I'm going to put them in the background of the original market. So we have in the background where consumer surplus was and where producer surplus was before the government steps in and does this tax on the market. Now, when the government puts the tax on the market, it reduces the quantity, right? So that means less units are going to be bought and sold. This is another example of the government stepping in and doing a policy that reduces how many units are bought and sold in the market. What happens? All of that consumer and producer surplus that used to be produced, remember the name for that? That's called a deadweight loss. This is specifically the deadweight loss from a tax. There's an inefficiency that's introduced in the market. Again, can you remember, what does it mean when we have an inefficiency in the market due to taxation? To tell me about the inefficiency, you should be telling me something about the benefits and the costs, right? So deadweight loss, absolutely. When the government steps in and does a tax in the market, it creates an inefficiency in the market. I don't like inefficiencies. I don't like deadweight loss. That's economic value. Some of it went to consumers, some of it went to producers. Now no one gets that value. How about consumer surplus? If you recall, consumer surplus is the area below the demand curve. So I'm going to start at the demand curve, and now I want to go down. What's the new price buyers pay? I stop right at PB. That's the price buyers pay. And how many units do buyers actually purchase? Right? So I'm going to keep shading to the right until I stop, and this is the new amount that buyers purchase. So this consumer surplus, a lot of it overlaps, all of it overlaps with the previous consumer surplus. But notice, there was this area of consumer surplus that no one buys, but there's also this area right here. Who gets this consumer surplus now? Is it producers? No, let's hold off for a second, but it's not producers. Producer surplus, right? It's the bottom triangle. It used to be the area between the supply curve all the way up to the price sellers received. Now, the government steps in, they put this tax on the market. Which of the two supply curves do you think I should start shading? Actually, right, so a lot of the times I hear a split decision. A lot of people want to use that second one. It's actually still the original supply curve, which makes our comparison really easy to do, right? Remember, we define producer surplus in terms of the cost of production. So I want to use the supply curve that only shows the cost of production. I take my go all the way up to the price sellers receive. In this case, sellers are holding on to a lower price of P star. So this is where the producer surplus is. And again, I shade all the way to the right until I stop at the amount of units that sellers are able to sell in the market. So again, that's a nice little triangle. Everything from it overlaps with the earlier producer surplus, right? But the problem was that earlier producer surplus, some of it is now deadweight loss, and some of it is in this little region right here, right? So if I had to start to summarize up what was going on, it looks like consumers are clearly worse off. Consumers don't like taxes because, for two reasons. Number one, it makes their prices higher, and they buy less. And when you purchase less, you have less surplus. But also, producers don't like taxes. Producer surplus is lower under taxes, same reasoning. They have a lower price they receive and they don't sell as much. Both of those factors are leading to a lower producer surplus. But now what about this area that we didn't shade in yet? What kind of shape is that, right? So it looks like a nice little rectangle, right? When I think about what does that rectangle represent? Well, here we go. What I know is the base of that rectangle is the total amount of stuff that's still purchased. But what's the height of this rectangle? The height of this rectangle, the top of it starts at PB, the bottom of it starts at PS, and if I've drawn this thing carefully enough, I should be able to grab this little value down here, and it should roughly match up. This is the same amount that I shifted the supply curve. And remember, I shifted the supply curve by the amount of the tax. The difference, the vertical distance on this rectangle is the difference between PB and PS. And if we go back a story, the distance, the difference between the price buyers pay and the price sellers receive, that difference was the $5 tax, or that difference between the price buyers pay and the price sellers receive was the 46-cent tax. The vertical distance, the height of this rectangle is the tax per unit. So if I take the tax per unit and multiply it by the total amount of units that are taxed, in green, what we're measuring there is what we call tax revenue, right? So tax revenue is the total amount of money that's being collected by the government through taxation. Notice, where does that tax revenue come from? It comes out of consumer and producer surplus, right? So again, that tax revenue, its economic value, some of it came from consumers, some of it came from producers. That's, again, a redistribution of value. I don't care as much about redistribution. What I care the most about is the inefficiency that's caused from the deadweight loss. But this redistribution of value from taxes going up, that's less of a concern. I care about it, but not nearly as much. So real quick, I want to tell one quick story though, right? What was this? Could you graph this out when we had zero taxes? In essence, if we have zero taxes, we're telling a story like in the upper right-hand corner, right? If the tax rate were zero, how much tax revenue would we have? Zero. Now, as we started increasing the tax rate, this tax revenue got a little bit bigger, right? What I'd like to do is I want to stop this, and I'm not going to fill in all the pieces with you. I'll just pause and then bring it back with a doubling of the taxation. But think about what that might look like. Does this match what your expectations were for a doubling of the taxes? And again, we can ask a follow-up question. Can you go through consumer surplus, producer surplus, deadweight loss, and taxation? Or not taxation, but the tax revenue specifically. Did those increase or decrease, or is it ambiguous how they changed when we doubled the taxes? Can we also consider what it looks like if we were to triple the taxes? We've tripled the taxes. Can we quadruple the taxes? Does this match your expectations? And you know I want to ask one follow-up question. What if we raised taxes just a little bit more? It's possible that if the government put such a humongous tax on a market that it could completely destroy and eliminate all the market. The entire thing would be deadweight loss. So a follow-up question is, what's the level of tax revenue with this kind of market? And so you might want to think about how that also relates to this relationship between the tax rate and the tax revenue, not the tax rate, but the tax rate, right? Think about what that picture would look like of tax revenue across different levels of tax rates. What do we do if instead of putting a tax on sellers in the market, we have something like a tax on buyers? I'm going to go through this one a little bit quickly because it looks nearly identical. In our rational model, where everyone clearly calculates the value of taxation in their cost and benefit calculations like machines, then it's going to look nearly identical to the one that we just went through. When there's a tax not placed on sellers, but instead is placed on buyers in the market, it has a very, very similar outcome in that buyers, it reduces their effective demand, right? So effectively, when you go in and you buy, see a sweater on a shelf, instead of thinking about you're actually going to have to pay the $100, you mentally add in the tax in this model, and you think about actually having to pay a price of $105 rather than $100. It effectively reduces your demand for goods and services, right? Not surprisingly, with this reduced demand, step one, where does it intersect with supply? That's going to be the quantity under taxation. And it's lower, just like before. Now, if I take that quantity and I look at the original supply curve, that's going to tell me the price that sellers are going to hold on to. And if I go up to the original demand curve, that's going to tell me the price that buyers are willing to, or the price that buyers have to pay. This is the exact same picture as what we drew before. The only difference was, rather than having the supply shifted, now we have demand decrease, but it's still going to reduce the equilibrium quantity under taxation, and it's still going to drive this wedge, driving prices higher for buyers, and sellers, trying not to lose so many buyers, are going to be willing to take the hit in the form of lower prices. It also means that consumer surplus, producer surplus, tax revenue, deadweight loss, all the same as the earlier graph. The only thing that's different is this shifting of the demand curve rather than a shifting on the supply curve. Right? So again, this gets back to this earlier statement that we said, if as long as we've got everyone rationally incorporating all the impacts of taxes into their decision making, then it doesn't matter, right, whether we put the taxes on buyers or sellers. From an economic perspective, it doesn't matter whether the taxes are placed on buyers and sellers. How about from a political standpoint, though, right? Political decisions are made usually by people who are elected to those positions. Politically, does it matter whether politicians try to put a tax on buyers or whether they try to put a tax on industry? One of those is a lot more politically palatable to voters, right? But industries also do a lot of lobbying to try to avoid taxes, right? And so that political decision about where you put the tax is a lot more complicated than this economic one in our model. As long as everybody's fully incorporating these prices into their decision, or these taxes into their decision, it shouldn't matter. So again, the graphs look the same. I could tell two different stories, right? So the buyers and sellers, it doesn't matter whether the government chooses to put the tax on buyers or sellers into the market, but notice these two pictures below, right? I've got question, do I have a tax put on buyers or sellers in this market? Do we have legitimate demand curves? Yep, on the left we've got a demand curve that's downward sloping. On the right we've got a demand curve that's downward sloping. Notice though that they look very, very different. On the left we've got this very, very flat demand curve, and on the right we have this very, very steep demand curve. So another follow-up question, how would you describe this demand curve on the left? Would you call it elastic or inelastic? And then we have this demand curve on the right, which is very, very, very steep. We also have two legitimate supply curves, right? The only thing that we need for a legitimate supply curve is it's an upward sloping line. We've got an upward sloping line on the left, we have an upward sloping line on the right, but again, this is about the elasticity. One is very, very steep, one is very, very flat, right? So we've got on the left a very flat, elastic demand and very steep inelastic demand. I'm going to see a very, very high number for the own price elasticity of demand and a very low number for the own price elasticity of supply over here. And on the right, I have the opposite case, right, where I've got very, very inelastic demand. So I'm going to have a very, very low own price elasticity of demand, and I'm going to have a very, very steep elastic own price elasticity of supply. I'm going to have a pretty high number for my own price elasticity of supply. The way that I did these, though, if you look at the vertical distance between the two demand curves, what you should be able to do, if I did this right, it's actually the same. I put the exact same tax on the left as I did on the right. What I wanted to compare was the impact of elasticity on taxes. Notice, right, the middle value is your P star, right? The middle value is P star in black, and then the top line is the price buyers pay. It's how much prices go up for buyers. Notice, between these markets, the one on the left, prices barely inched up for buyers, but on the right, we had this huge increase in the price for buyers when the government put a tax on this market. Notice that on the left, below the black line is the price that sellers hold on to. On the left, we have this huge, right? Sellers are willing to take a humongous hit to their market. Whereas on the right, sellers, they're barely willing to budge off their price that much, right? On the left, we've got the tax, the difference between the price buyers pay and the price sellers receive. Most of it comes in the form of sellers taking on lower prices. Whereas on the right, the tax, the difference between the two prices, is mostly by buyers paying higher prices. We refer to that as the tax burden. The tax burden is the percentage of the tax that's borne by either the buyers or the sellers in the market. And we've got a nice little equation down below to describe the tax burden. No, this is not a typo. Again, it's a little counterintuitive, but the buyer's tax burden, we take the two elasticities and we add them together. The buyer's tax burden has the seller's elasticity in their numerator, and the seller's tax burden has the buyer's elasticity in the market. So to put some numbers on it, on the left, let's assume that we've got very, very elastic demand. So let's say that we've got elasticity of demand of, let's say, I need an elastic number, so I need a number that's greater than 1, right? Let's do 2.5. And let's do for the seller's elasticity, it's elastic, so we got to do a very, very low number. Let's do 0.5. Real quick, with these values of elasticities, calculate the buyer's burden and the seller's burden. And this is pretty simple math, but when you're done with your calculation, what you're going to find is that for this market on the left, who had the bigger burden? And notice your value is going to be as a decimal, but you can absolutely convert it to a percentage, right? This is the share. This is the share of the tax that's borne by the buyers or the sellers. The general rule is, and again, think about for yourself a set of numbers for an elastic supply and inelastic demand, and you're going to get the flip of their burdens, right? You're going to get, whoever has the higher burden, it's always going to be the case that whoever has the higher burden of taxation is whichever side of the market was more inelastic, right? So on the left, sellers were the more inelastic. They were not as good at responding to changes in price. So when the government forces a tax on the market and messes with the prices, the side of the market that's less equipped to respond to changes in price are the ones who are going to have the larger share of the burden. And on the right, conceptually, right, we can just see without doing the calculations, you can see that buyers end up with a much, much, much bigger hit to their price. Why? Because they were more inelastic, right? The side of the market that is more inelastic is the side that bears more of the burden of taxation. Buyers are very, very inelastic on the right. That means they're not very good at responding to changes in price. So if the government puts a tax on the market, sellers know that they can just force that price, that higher tax, onto buyers in the form of higher prices, and buyers are going to stick around for the most part, right? The general thing to remember is whichever side of the market is more inelastic has the higher burden from taxation. So this also, right, we're going to bring this back to politics for a second, right? We've got FDR started Social Security, and you may know, if you've ever had a job before, you've noticed that you've got some FICA taxes that are FICA taxes that are taken out of your pay stub, right? You may have noticed those. The way that they originally pitched the financing for Social Security is, hey, let's not make this a bad deal for buyers where they have to fund all of their retirement security on their own, right? Instead, let's split it. Let's make buyers pay half of the taxes on Social Security, and let's have your sellers pay the other tax. So what you've probably seen is only half of the side, right? You see a little over 6% of your paycheck goes towards Social Security taxes. But actually what you don't see is there was another 6% that your employer had to put into a special account and send to the government periodically. And so in total, for every $100 that you make, it's over 13-14% that the government has to that is going to collect on the wages that were earned. It's only that you only see on your paycheck half of that taken out. What the government's trying to do is the government is trying to force this nice little 50-50 split between the tax financing mechanism for Social Security. And what we just said is economically, that's hogwash, right? Economically, it doesn't matter which side of the market is taxed. Rather, what matters is the elasticities, right? So I've got two different pictures here. Notice that these are a little bit different. On the left, who's paying these taxes? These are buyers. Buyers are paying these taxes because the demand is because we've got that decrease in the effective taxes. On the left, who do we have paying taxes? We've got supply. Notice, demand in both of these is elastic. Supply is inelastic. Notice, what's the distribution of the price buyers pay, the price, and the price sellers receive? It's the same. Elasticity is what determines the distribution or the burden of taxation, not whether the government wants to put it on buyers or put it on sellers. In a rational model where everybody is clearly and correctly anticipating the impacts of taxation on their decision making, it does not matter whether taxes are placed on buyers or sellers. What matters is the underlying elasticity. And again, the clear thing to remember is whichever side of the market was more inelastic is the side of the market that's going to be impacted by a higher tax burden. So my question to you is, for a labor market, which side of the labor market do you think is more inelastic? Labor supply or labor demand? And what's your reasoning?